Apart from the fact that the IIF says it's your fastest growing work stream, I can say that we at the Financial Times, we launched this new vertical about 3 months ago called Moral Money. This is what it looks like. And it has actually, against the odds and somewhat to our expectation, become the most successful new product we've ever launched thus far in terms of the growth of subscribers, the level of engagement, which is extraordinarily high, and the level of interest. So if any of you haven't seen it, please do look at it. It is certainly a very hot topic. And what is particularly fantastic about today's panel discussion is that in a world which is often marked out by a rather smug sense of consensus, we now potentially have some disagreement. It's worth stressing that point because there was a time in Washington where people thought the whole point of Washington was to air and expose civilized disagreements and to exchange views to provide a more constructive process for creating policy making. You don't often have that these days in other parts of Washington, but we're going to have that this morning because we don't just have a different perspective on different sides of the Atlantic. I think we also have different perspectives about what could or should actually be done in the months ahead and the years ahead. So I'm not going to waste time with long introductions. You can read their bios in the book. I'll simply say that we have on the one hand Frank Elderson, who's been at the heart of efforts from your role at the Dutch Central Bank to drive forward what's known as a network for greening the financial system. That's the Central Banking and Regulation Coalition, which I think now has about 4 dozen members. Is that right?
46.
46, okay.
Growing.
Right, and growing. Yeah, growing very fast. On the other hand, we have Hester Peirce at the SEC, who gave, to my mind, one of the most memorable speeches I've read from the SEC in the last year, where she suggested that what was happening in the ESG world today was a bit like Scarlet Letter, that wonderful novel where essentially we're branding companies and investors and institutions as being immoral and unworthy with a scarlet letter in a way that was not just unfair, but potentially very damaging for the future of finance. So, Frank, let me start with you. What exactly are you trying to do with the NGFS, and what gives you the right as central banks to get involved in this whole debate, given that there was a time when people thought central banking was all about price stability?
Right. Well, very good questions, and thank you, and congratulations on your Moral Money success so far. The NGFS, just a couple of words on that. 2 years ago, we came together with 8 central banks and supervisors around the world, already then on various continents, so it's not just a European thing at all. And this group has now grown, as I said, from 8 till 46 members around the globe. Actually, last month in New York, the New York State Department for Financial Services joined as a member as well. And then there's a number of highly esteemed observers, such as the IMF, the World Bank, the Basel Committee on Banking Supervision, and the like. What is the key insight I think that we have achieved as a group, as a coalition of the willing, as you put it very aptly, I think? That is that climate-related risks are a source of financial risk. And understanding why that is, I think, has made us comfortable coming out and making the statements and doing the work that we do. And just, 2 sentences how that works. Climate-related risks via a physical channel. There's more floods. There are wildfires. I flew to St. Louis earlier this summer, and I saw the flood by myself. All these physical risk and manifestations thereof, they have financial implications. And then there's the transition channel. Governments are not just going to be sitting on their hands. They're not going to be sitting idly by and see how the world suffers from these physical risks. No, they will take actions. And these actions, they will in the end create the risk of stranded assets. They will phase out certain technologies. They will phase out certain ways of doing business as we do today. So via these 2 channels, again, climate risk translate into financial risk. we are, as a central bank and the regulatory community worldwide, we are about financial risk. So there was no need to change our mandates, no need to change banking laws and banking acts, as we are mandated squarely to look at how financial institutions manage their financial risk.
Right. Commissioner Pearce, do you agree?
Well, I certainly think that Frank's been very successful at pulling together a lot of people in his network, so I agree with that point. I should start by saying that, speaking of lack of consensus, my views represent my own views and not necessarily those of the SEC or my fellow commissioners at the SEC. I don't think that there's anything unique about climate risk that requires as much attention as has been paid to it. Companies that, throughout the economy are thinking about how different climate risks might affect them, and that differs according to industry. And financial institutions are likewise, financial companies are likewise thinking about these things to the extent they're relevant. I mean, insurance companies, for example, always think about risks, and climate risks will play into that. So they're factoring that in already. And so it seems a little bit odd to me to take this one particular risk and highlight it in the way it's being highlighted, so that it then seems to dominate all other risks. That I don't understand the reasoning behind that.
Well, Frank, what would you say?
Well, a couple of things. First of all, we have been thinking about, and I'm speaking as supervisors now, maybe a little less as central banks, because our membership is, some of them are integrated central banks and supervisors, others are not. We've been thinking about for decades about credit risk, etc. And there's many other risks that are very well established. Everyone knows about that. People have studied that. They identify themselves as a credit risk expert, etc. In order to make sure that there is mental space to understand that there is something out there that they have not been thinking about so much. And indeed, there have been insurance undertakings that have been looking at climate risk for a long time, but there have been many other financial institutions which have not, and which are on the record of stating so, and which are on the record of saying that they're now investing in their own capacity, are doing capacity building and information sharing in order to get better at that. So it's not something that is already out there for a long time. So you need to make a splash, so to speak, to make sure that people are opening their minds. But I think you pointed a very good point. Why is climate change different? And actually in the report that we published this spring, we tried to think about that, and we came up with some of the elements and aspects of climate-related risk, why we think they are different from many other structural changes in the economy that we are seeing everywhere and any time. One of is the far-reaching impact and breadth and magnitude of the issue. Climate-related risks will affect all actors in the economy. That is one aspect. All sectors, all geographies, households, governments, local government, businesses, the foreseeable nature. We now know that this is happening. So it's not just a risk, it's out there. The irreversibility, the changes that we see will not in our lifetime be reversed. And the dependency on short-term action. If you don't take action now, we will be in trouble. And more drastic measures will be taken later on. So that's
right.
So these four elements, we think, make climate-related risks stand out.
Hester, do you think that companies in America today are disclosing their climate risks adequately?
Well, certainly our rules, we are in a little bit of a different stance, because I'm a regulator of securities markets, you're a central banker, so those are different mandates. But one of our key mandates is to get to investors information they need to make decisions about the financial future of the companies in which they're investing or potentially investing. And so we try to get material information to companies. And one of the things that you have to talk about is you have to talk about the risks that you face. And so yes, they're thinking about climate risks much as they would think about other kinds of risks. There's of course a whole, there are a lot of companies out there, so I'm not going to come out and say that they're all doing a great job, but I mean, part of what we do is we look at the disclosure that they're making.
Right. I mean, by the way, I should say, I never know how to address people in a panel with a Dutch official, and in Holland, in Netherlands, people only ever use the first name, and in Washington, where titles rule. So if I call you Commissioner and you Frank, please don't take offense. That's part of the cultural juggle.
I didn't know this, which underlines your point, so thank you.
Exactly, I know. So, but Commissioner, do you think, though, that it's possible to introduce a framework to encourage companies to report climate change risk accurately and fairly at a time when we have an administration that essentially seems very ambivalent about whether climate change is even an issue?
But again, each company has to look at what its industry, its business, what it's doing, and it makes very bespoke decisions about how to make disclosures. There's no framework to tell companies how to do it, because it just wouldn't work. It's a very principles-based regime. You figure out what's material, and you disclose what's material. And so this notion of having to centralize all of this doesn't make a lot of sense to me. So I think we've been providing guidance to companies in general, and I don't know that there's no one has shown me there's a specific need to pick this one risk and say we need to do more. And I think there's a potential danger, which is that a lot of the science is, there are a lot of uncertainties about what will happen, when it will happen, and the magnitude of what will happen. And so I don't know that it makes sense for us to try to centralize decisions about how all of this is going to play out. I think it's actually much better to have a lot of different people thinking about it from their unique vantage points. We're likely to get much better information that way. I'm a believer in decentralized knowledge, and so I think actually having a bunch of people look at this problem from their perspective is going to end up in people taking better steps to deal with what's coming, and potentially, ultimately what we're all trying to hope for, right, is that there are new technologies that come online, and that solutions that we don't even think about today are going to be there tomorrow, because our capital, because our system works at distributing capital to the best uses.
But Frank, yes.
Well, maybe reacting to that, I agree that what we need is many actors, private and public, building knowledge, awareness, sharing good practices. So you will, if you look at the reports that we have done so far as the NGFS, you will not find, one specific technology or one specific way of disclosure or transparency that we think this is the way forward. That's too early, and maybe it will never be. We will never get to that stage, and maybe there's no need for that. But maybe to explain a little bit the kind of things that we do. We have various work streams. One work stream deals with Macroprudential super. So how do institutions actually manage their climate-related risks? What we will be doing is publishing in the beginning of next year a kind of like a compendium. So that's not a regulation, it's not binding at all, but it's kind of like a compendium of things that we see. We supervise now together as a group 2/3 of the world's systemically relevant banks and the insurance undertakings. So we see a lot of things that are happening, and we feel that we can do a service by saying these are the things that we see. We also look at ourselves and we see how do we supervise ourselves, and are there good practices that we can share, that there might be central banks and supervisors around the world that have not been doing research on this yet, and they can look at our publications and say, okay, well, this and this does not. So we are very far from saying this is the way forward, but we are collecting evidence, we are looking what is going on, and we are giving it back, and we are helping those who might be lagging behind by showing what those who are in the front of this are doing.
And yet, I mean, Kristalina Georgieva started the IMF meetings yesterday with a big panel on whether central banks should now get involved in the fight against climate change. And she pointed out that obviously there are people right now pushing for mandatory disclosure rather than just voluntary disclosure through TCFD. There's a discussion about the potential, weighting of assets inside bank balance sheets and insurance portfolios according to whether they're green or brown. There's even discussion about quantitative easing. I mean, these are a long way beyond just a kind of happy kumbaya style information sharing network.
Exactly. And we need to go there to the extent that if you want to, you say many firms are disclosing. In order to have comparability, in order for financial institutions to be able to manage their risks, they need this data. So one of the things that we put in our report is that we need more data. We have supported the TCFD. Now that you mentioned the TCFD, we didn't go as far as to say they need to make TCFD recommendations mandatory.
But would you like that?
Well, I think in the end that is the way forward. Others will have to decide that. If, and you know this better than I do, but if you look at the trillions that are already now under the TCFD regime, if you like, that is going very fast. So we might want to see how that develops. But in the end, I think there is a need for comparability in disclosure and data worldwide, and TCFD can play a big role in that.
Commissioner, would you accept TCFD being mandatory as a form of disclosure?
No, I mean, I'm not a believer in those kind of disclosure mandates. But I think one more fundamental disagreement that maybe we have is I'm not a big believer in macroprudential regulation, and this is another iteration of macroprudential regulation. And it really is trying to centralize how we approach problems, and I think it will lead to potential financial stability problems actually instead of benefits. So I did have a chance to take a look at the report, and I thought there was some interesting things in there, but there are assumptions built in about the magnitude of the problem relative to other problems, which I think is a concern. And then there's this push towards uniform comparability, which I understand the desire for comparability, that investors may have a desire for comparability, but by building out and identifying certain industries as brown and other ones as green, you're directing assets, effectively directing assets to certain industries, and that will affect innovation, that will affect the way certain industries, whether they perform or not, and we could end up losing valuable innovation because something is labeled as brown and not green. We will end up with a less prosperous global economy, which we all know that prosperity is actually good for the environment. It's good to bring people's standard of living up because then they care more about the environment. And so by compromising growth, I think we're actually hurting the objectives we're trying to hurt.
Can I really ask one question there? Right. You say that money is going into innovation and investments if you don't get in the way. But the reality is at the moment, there are a number of structural impediments in the market which is essentially preventing money going into green investments on the scale that's needed. Do you not think that it's up to regulators and policymakers to get involved in that?
What are the barriers?
Well, in many ways, you're looking at, the argument would be that you're essentially disincentivizing investment in risky green innovations because there's less of a guaranteed payout and things. So, you could actually take policy measures that would actually encourage innovation more effectively.
I've never known regulators to be the ones who can figure out which innovation is going to radically change the world. In fact, innovators are usually stuck 20 years behind, regulators are usually stuck 20 years behind innovators. And so if we, and this has been a problem that bothers me in Washington continuously, which is that regulators think if we just collect a little more data, we can figure it out better than the rest of the marketplace. And that is just, that it's just inaccurate. There's some guy in his garage in Oregon figuring out a solution that none of us on this stage has thought about. And I want that guy to be able to get the capital that he needs to be able to develop that innovation and make it go. And so there's nothing that's blocking him except for we need to do some work here in the US at least on our regulations so that it's easier to get money to folks who are not in Silicon Valley or Boston or New York. But as we work on those issues, I think the other issues getting solved.
Frank.
Well, I would say that it would be a misconception to say that if regulators were to argue for a more standardized, uniform disclosure regime, that that is so that regulators can make choices that private actors can do much, much better. That is a misconception. We would plead for that so that the private sector can actually get their act together in a much better way.
But you're
So it would,
baking
that is one. And the other thing that you said earlier about macroprudential supervision, you might not be a great fan of that. It is something that worldwide is being done very seriously. I know that there are also US authorities taking this very seriously. One of the things that we are doing in NGFS is to think, can we create more forward-looking risk management techniques, such as there are scenarios and stress testing. And one of the things that we have been doing as a Dutch central bank is to stress test our financial system and to see what would happen to their balance sheets if there were to be a higher CO2 price. And that is one of the impediments that we have today, that certain externalities are not being priced. Governments, at least almost all governments in the world, have signed up to the Paris Agreement. That means that they will make climate policy, so whether you like it or not, whether you believe in climate change or not, governments will legislate on it. They are legislating on it. So that means that if you are a private citizen, if you are a private entity, if you are a financial institution, you will have to deal with that reality. There is going to be legislation. So if that legislation is going to be there, if we postpone this legislation, by the way, will be more drastic, will be more radical, will be less good for financial stability. That's why we argue for climate laws and for clarity, so that people know how they can manage their business cases going forward. So my prediction is that these measures will going to be taken. And if you are a financial institution, you need to look at your balance sheet. And you need to look what happens if there were to be, for example, a higher carbon price. Or an example I give in the Netherlands all the time, there's now legislation that says that all office buildings need to have a C label of energy efficiency. We have different labels. C is okay-ish, B and A is better, and below C it's brown, so to speak. As of the 1st of January 2023, all office buildings in the Netherlands have a C label. So we went to our banks 2 years ago and we asked them, do you know about the energy labels of your of the office buildings that you have exposures to? Half of the banks didn't know. So you say that everyone is doing their jobs. They're not doing their jobs. They didn't know. The other half knew about half of the exposures to the office buildings. So during our exam, they started making this inventory really quick. And then that is the interplay, I think, which is very good between regulators and supervisors on the one hand and the private sector on the other hand. During our exam, they started doing this, and they started also seizing the opportunities. So they went to their clients and say, you know, you are the proud owner of a brown office building that in 5-6 years' time will no longer be allowed to be rented out. But I can help you because I can, you know, give you an additional loan. You can refurbish the office building. In the end, there will be a positive business case because, you know, your energy and the energy bill will go down, etc.
Right.
So we come in from a risk side. The private sector understands, but was not doing this yet, and we acted on public information because we knew this law was coming. And I give this example because many of these laws around the world will come. And they will not only come from federal governments, they will also come from state and local governments.
Right.
So my point would be on the lookout for governmental action. It will come, whether you like it or not, whether you believe in it or not, and manage your risks.
Commissioner, do you not worry about a so-called climate change Minsky moment, as Mark Carney has said? That suddenly,
Say that again?
a climate change Minsky moment is an image that Mark Carney uses to describe the idea that suddenly the impact of these regulations will hit and investors will panic.
Certainly regulation is something that companies think about all the time. There are regulations coming from all sides. And so, yes, you can cite examples of individual companies that haven't thought of a particular regulation, but it's something that it's a risk that they're all thinking about. So in some ways, it's a self-fulfilling prophecy, right? That you set these requirements in place, and then you tell companies you got to comply with them, and so you really are driving business activity, and I question whether that's wise, because I think by building in taxonomies of how of where things fall, A, B, C, D, you're essentially driving capital into those places, and I hope you're picking the right places.
Well, when you say you, this is governmental regulation. This is not us as a central bank and supervisor. What we say, we draw the attention of the financial sector, and we say, please be aware. And my point is, of course, there's all kinds of legislation all there, and the financial institution have been looking at legislation forever. That is not new, but there is an awareness thing. And this was not just some of them. Half of the banks in the Netherlands, and this is the Netherlands, it's not a country where people didn't think about flood risk and climate-related issues before. Half of them, 2 years ago, did not know. They had not done this work. They had not done the nitty-gritty homework of looking at the exposures that they had. This is credit risk management. So there were people in credit risk management that didn't look at this. Now they do. So this awareness thing is important.
Well, I mean, I think one flood can do more than a report on getting people to think about flood risk.
Can I ask this way? Do you think that the US government regulators, central bank, will join the network for greening the financial system?
Oh, I don't even speak for the SEC, so I'm certainly not going to speak for our central bank.
Right. Do you think it should?
Again, I mean, my purview is regulating our capital markets, which I think are the most powerful markets, frankly, in the world. I think our capital markets are fantastic at solving problems, and they're the foundation for the rest of the economy. And so having healthy, strong financial markets, for me, from my perspective, is the way to solve all of these problems that we're all worrying about.
Right.
So I will trumpeting the ability of individual people working together through voluntary action in our markets to solve even the most difficult problems.
Well, we're going to be hearing from some of the private sector voluntary actors in just a moment. But before we do, I've got a couple of other quick questions. Firstly, do you ever think, Commissioner Pearce, that this explosion in ESG activity, which we heard about earlier, is just a fad, just a function of a bull market that will vanish in time? Do you think it's here to stay?
Well, I think one thing that characterizes the debate is there's real ambiguity about what ESG means. A lot of ESG factors have been considered by investors and by corporations throughout time. I mean, you're going to consider your effect on the local community. You're going to consider your effect on employees, your relationship with employees. These are things that are natural for companies that are trying to succeed to think about. So a lot of it is just stuff people have been doing for a long time, and now we call it ESG and it sounds cool. So I think people are going to stop talking about ESG eventually because they're going to realize they've been doing it all along. I do think some of this green, this emphasis on giving people credit for investing green, I suspect that will pass away. And we've seen in the past when the government tries to give preference to certain kinds of investments, whether it's through a mandatory disclosure regime that does that implicitly or through more explicit means, it's led to financial instability and a lot of really poor investment decisions, which we will pay the price for. And then after we pay the price for that, maybe people will stop worrying so much about labeling something green and just try to find the best thing they can invest in to make the biggest difference in people's lives.
Frank, we're almost out of time, but do you have any comment in response to that? Do you think it's a fad?
No, it's not a fad. I think that the world is on a trajectory, and this is not a central banking speaker, but this is someone who reads the reports of the IPCC. on a trajectory that makes that governments will have to take increasingly drastic action to mitigate the effects of climate change. This will mean that there will be trillions and trillions of dollars being invested both in mitigation and adaptation. That means that there are lots of risks out there, and that means that there are lots of opportunities out there.
Right.
And I would strongly send the message to any financial institution around the world to take that very seriously, both to manage their risk and to seize these opportunities.
Right.
Well, I think we can agree on the fact that there are risks and opportunities out there. I just hope that that we allow the private sector to figure out where they are instead of
I'd like to
re-identify them.
By the way, I should say thank you to both of you for expressing your views so openly and courteously. I'd like to do one quick thing before we end, which is actually to take a vote of the audience. I'm curious as to where the audience sits. This is also a way for me to check whether you've had enough coffee this morning to wake up and actually listen. Who here thinks that it's beneficial that groups like the Network for Greening the Financial System are getting involved and trying to set parameters and potentially go further in shaping regulation?
How come you're not doing anonymous voting like we did for the lobster?
Who thinks that, in fact, the government should stay out of this, and, in fact, Hester Peirce's arguments about the need to let private sector players shape capital markets is correct? Okay, well, I'm not going to comment on that other than say it would be very interesting to come back in a year's time or 2 years' time and see how attitudes are changing, because it is an area of great flux. Whether you think it's a fad or not, it's an area that a lot of people are talking about and very interested in. It's one reason I say why we launched Moral Money, and it's one reason why I salute you for doing the panel today at the IIF. And the next session is going to hear what the private sector makes of this and whether they're willing and ready to pick up the baton or want governments to get involved too. So thank you both very much indeed for a fantastic debate.
Thank you.